All right, let's dive in. Today, we're going on what is basically a multi-billion-dollar treasure hunt. We're going to peel back the layers on the high-stakes world of fossil fuels to figure out just how companies can bet an absolute fortune on something they can't even see miles beneath the Earth's surface.
So here's the big question, right? How in the world does this all work? How do you justify spending billions of dollars on what is, at the end of the day, a highly educated guess? A hunch, really. Well, that's the puzzle we are going to solve today.
But first things first, before you can even think about hunting for this prize, you've got to understand what it is. And to do that, well, we need to rewind the clock by millions and millions of years.
So, what are we really looking for down there? We're talking about fossil fuels, oil, gas, coal, you know the stuff. But think about this. It's literally the super compressed, cooked, and transformed remains of ancient life. Dinosaurs, plants, tiny little sea creatures. A process that takes an unimaginable amount of time turns all that into the energy that powers our world. The timescale is just mind-boggling.
Okay, so we know what we're looking for. Ancient sunlight, basically, trapped underground. Now, how do you find it? This is where we get to the exploration phase, which is like a modern-day treasure hunt, but with some incredibly sophisticated tech. The #1 tool in the toolbox for this hunt is called a seismic survey, and the idea behind it is actually pretty brilliant. The best way to think about it is like a medical ultrasound, but for the entire planet. Seriously. They create these powerful sound waves, these little shocks, and then they just listen for the echoes that bounce back. It lets them build a picture of what's hidden miles beneath our feet.
And the process itself is a really neat three-step trick. First, you create the sound waves. Second, you listen very, very carefully and record how they bounce back. And third, you feed all that data into a supercomputer that builds you a map of the underground. That map, that's your treasure map. But, and this is the most important thing to get, even with all this incredible technology, it is not a sure thing, not even close. Exploration is still a game of trial and error. It is wildly expensive, and there's always that very real looming risk that you'll spend millions and come up with absolutely nothing.
So, you've got your map. You've got a spot that looks really, really promising. Now comes the moment of truth, the billion-dollar question. Do you drill or not? This is that exact point where all the cool geology slams right into hard-nosed economics.
And you have to realize this. It's not enough to just find the oil. That's only half the battle. You have to be confident you can find enough of it to make the entire crazy expensive venture profitable. The potential prize has to be big enough to justify the massive upfront cost and that very real risk of failure.
So how on earth do they calculate that risk? Well, they use a surprisingly simple-looking formula. It's called the expected monetary value, or EMV. Now, it might look basic, but this little equation is the engine that drives these huge investment decisions. It's all about balancing the odds of success against potential profits and costs. Let's break it down. First up is P. That stands for the probability of success. And get this, even in a really promising spot, the chance of actually hitting a commercially viable oil field might only be 15%. Think about those odds. You're betting huge money on an 85% chance of failure.
Next is NPV, which stands for net present value. This is the jackpot. It's the total potential profit you could make if you do hit it big. So for our example, let's say the prize is a cool $100 million.
And finally, you have E. That's the exploration cost. This is the money you have to spend just to find out if you're right. It's the buy-in for the game. And in our case, it's $10 million that you are gambling on that 15% chance.
So let's do the math. You take your 15% chance of success, multiply it by that $100 million prize, and you get $15 million. Then you subtract the $10 million it cost you to explore in the first place. You're left with a positive $5 million. That's your EMV. The risk-adjusted reward is bigger than the cost. Green light. The project is a go.
But wait, what happens when a government decides it wants a piece of the action? This is where it gets really interesting. Let's say a government demands a 50% share of all profits, but doesn't share in that initial $10 million exploration risk. Well, look what happens to the math. Our positive $5 million EMV suddenly flips to a negative $2.5 million. Just like that, the exact same project with the exact same geology goes from being a smart bet to a guaranteed money loser. That right there is the power of policy.
Okay, so let's say our project got the green light, we drilled, and boom, we hit oil. Fantastic.
But the journey is far from over. Now we have to move from just finding it to actually developing a full-blown production field.
You see, not all discoveries are created equal. The industry has these very specific ways of classifying them based on certainty. Proven reserves, that's the gold standard. You're over 90% sure you can get it out of the ground economically. That's bankable. Probable is more like a 50-50 shot. And undiscovered resources, that's still just a good idea, a theory. What really matters is that only the proven stuff counts when it's time to write those massive checks for development.
And it's not just about how much oil there is, it's also about what kind of oil it is. You've got light, sweet crude, that's the good stuff. It's low in sulfur, flows easily, and sells for a premium price. Then you've got heavy, sour crude, which can be thick like molasses and costs more to refine, so it sells at a discount. The quality of the oil you find has a huge impact on your bottom line.
All of this, the risk, the cost, the quality, it all leads us to the final critical question. Once the oil is finally flowing and the money starts pouring in, who gets it? How is that massive profit pie divided up?
To understand this, we need to know a key economic term, resource rent. Now, this isn't like the rent you pay for your apartment. Think of it as the bonus profit. It's the extra value that exists simply because you got lucky and found a valuable resource in the ground. It's the pure value of the oil itself, and it's the pie that everybody, companies and governments alike, wants the biggest slice of.
And that pie, that resource rent, can get bigger or smaller depending on a few key things. You get mining rent if the oil is just easy to get to. You get technological rent if your company has better, cheaper tech. Positional rent comes from being close to your customers, saving on shipping. And of course, there's quality rent if you find that premium, light, sweet crude we were just talking about. Each one of these just sweetens the pot.
So governments step in to capture their share of that rent, usually through things like royalties and taxes. But here's the incredibly delicate balancing act they have to play. If they tax too much, sure, they get more money today. But as we saw with our EMV calculation, they can scare away all future investment for tomorrow. It's a constant tightrope walk between short-term cash and long-term prosperity.
And that brings us to the biggest question of all, really. All these calculations, the EMV, the resource rent, the tax rates, they're all trying to figure out what to do with a resource that is, by definition, finite. It will one day run out, and it forces us to ask a really deep question. How do we balance the value of using this energy right now today against the value of potentially leaving it in the ground for future generations? That is the ultimate economic trade-off.